Recording this. All right. So, who are we here with today? Can you introduce yourself?
Austin Graff from Opal Investments or Opal Capital Management.
Awesome. And where are you from?
I currently reside in Boca Raton, Florida, but I grew up in Wisconsin.
Wisconsin. Now, what made you think to move to Boca?
I made actually a circuitous route around the country. I started my career in New York City,
Okay.
and then I was hired for a position in Southern California, which lasted for a while, and then we moved to Austin, Texas, back to Southern California. And then in the middle of 2020, we realized that we might not get to see my in-laws for the holidays. And so we ended up driving across country and renting a place for 3 months, and we haven't left since.
That's awesome. And you like it, give or take?
Yeah, we love it here. It's great. I mean, we have a young family and have in-laws in the area, and my parents are in the area. So it's a great lifestyle for us as working professionals that also have a family.
Mhm.
Having family close is really important.
Totally. I understand that. So tell me about Opal. What is this and how did the fund start?
Yeah, so Opal Capital, we actually started, I mean, just to back up a second, I was a global dividend portfolio manager at PIMCO, where we took essentially some seed capital from PIMCO and turned it into global dividend funds with about $5 billion in AUM. And one of those funds was a mutual fund with a 5-star Morningstar rating. So we were actually pretty successful at managing these funds, but also at raising some assets. And so I left PIMCO in 2015, mainly like for a variety of reasons, some of which was just to get a little bit closer to the end investors, as I was a relatively young PM, just like looking to have the most impact possible. And so I started working with advisors, helping them with their investment programs, sitting on their investment committees. And in pretty much the summer of 2020, one of the advisors came to me and said, "Hey, we're looking to recruit someone. They're coming from a large institution. A majority of their book is in dividend equities. Could you help me manage these equities?" And I said, "Absolutely. I've done this, my entire career, pretty much looked at dividend paying equities." And so we set up a dividend SMA in the summer 2020. And then shortly after that, another advisor I knew said, "Hey, I love your strategy, philosophy, approach to investing. Will you do this in ETF form?" And I said, it's tough. You need a lot of money to do that." And he said, "Well, just tell me how much you need and let's get this going." So in January of 21, we launched DIVZ, which is the Opal Dividend Income ETF. And that primarily focuses on 25 to 35 US listed equities. And we're a dividend fund that tries to generate the performance of an attractive yield today that's also growing over time. So we think that this solves a problem that a lot of clients have, in that we're not just, looking for growing yields, and we're not just looking for high yields, because each of those have their own problems. We're looking for something that's providing a specific outcome for clients.
Yeah, I that's good that you touched on that. So I saw and you correct me if I'm wrong, I saw the dividend income is 2.24%, but the stock is up, kept as far as last night was up 10.78% in the past 6 months, which is huge because it doesn't seem like you guys are you're not hitting the NAV erosion, which is so popular in like the yield max funds or the
Yeah,
defined funds.
exactly.
You guys are still climbing. How do you manage that?
So our yield's actually in the low threes. There's a little bit of wonkiness because at the end of the first quarter, we switched over from paying a quarterly dividend to paying a monthly dividend.
Yep.
And so when they annualize that stuff on a backwards looking basis, it throws things out of whack. But the yield is about 3%. And really what we do is we look for quality, right? So my big pet peeve is when people throw these big yields out there. It's almost like catnip for investors. They look at the yield and they think about nothing else. They're like, wow, if I can get 10, 12, 13%, I'm golden. And they don't realize that they got paid 13%, but then the net asset value declined by 20% and they ended up losing money. And so what we do is we say, hey, let's look for companies that are high quality in nature. They have not only the ability, the willingness to pay a dividend, meaning that management has historically paid an attractive yield, but they have the ability. So we do a free cash flow analysis in every company that we own, and we make sure that the company has significant free cash flow in excess of the current dividend payment that they make. So then they have kind of that stability and durability in growing that dividend over time. But the quality factor is a big reason why you're seeing the capital appreciation through this year, as we own names that, you know, are benefiting from some of the growth in the market, and we aren't just focusing on names that are paying out as much dividend as possible.
What are some of those names?
Well, a big winner this year has been Broadcom. It's been a beneficiary of AI. It doesn't have a huge yield on it, and this is where there's a bit of a balancing act on how we are investing in companies. Some companies have, you know, that 1.5% yield that's growing at 20% a year, and that's a great investment. And then we own some names that have I mean, we own a name with a 10% yield that's still going to grow a little bit, but not a lot. And even that name is up, you know, call it 10% this year. So 10% in addition to the dividend yield, it gives you a nice 20% return, assuming they continue to pay that yield. But we have kind of a barbelled approach with some AI names, and then a different approach on AI where we early on identified the fact that utilities were going to be beneficiaries of artificial intelligent energy usage. And so we owned a few of the beneficiaries in the form of utilities, which we still think are relatively attractively priced, with a decent growth runway ahead of them.
And are these limited partnerships?
No, they're all, so it's all qualified dividends. So everything's a corporation.
Yep.
The closest thing we have to a limited partnership is Kinder Morgan, which just reported last week, and they reported that they're going to be big beneficiaries again from AI because so much gas is going to be needed to run the power plants that are going to be powering AI. So the stock's up pretty considerably. It's got a nice yield. Kinder is unique in that it's not an MLP, so they went to the corporate structure. There are other MLPs in the space. We tend not to like the non-qualified dividends because they appear to be returns of capital, and they look a lot more like some of the yield max products or whatnot that you referenced, where they pay you a bunch of income, but then the net asset value goes down, and we don't think that that's
Then
necessarily
you're
a good
taxed at the highest amount.
Yeah.
You know, everything you're saying sounds exactly what I'm trying to do because I have a lot of qualified dividends, and then I offset that with the Apples and the Amazons to try to balance it out. Exactly what you guys are doing, and I just started adding like ET in there to try to get some of the commodities. You know,
Yeah.
everything you're saying is like spot on. It's exactly how I personally invest. So I love this. This is fantastic. This is a great fund.
We also have a fair amount of energy exposure if you're looking for a way to balance that out. We found that, especially more recently, as some of those technology or AI names trade off, energy names have been trading up nicely. So it creates a dampener in the fund. They also have reasonable yields. I mean, they used to have great yields. If you looked at our performance in 2022, we were up about 4% when the market was down. It comes to quality, but it also comes to being forward looking.
Yep.
So we like to try to say like what's on the horizon that these companies are going to benefit from, rather than just looking in the rearview mirror. So there's a lot of passive options out there that are purely rearview mirror looking, and people are really excited about them right now because they're cheap and the market hasn't done anything but go up for the last 10 years, more or less. And so they all look really smart, but if there are any true like clouds on the horizon that create some volatility in the market, that might not be the best place to be invested.
Yeah, you're right. Everyone looks like a genius right now because the market just keeps. It doesn't matter what you put it in, with the exception of Disney. It's going up. I'm
Yeah,
still
there are a
recovering
couple
from
others.
Disney.
There's that Walgreens out there for a lot of dividend investors. We got out of that early, but that one's been, a really tough one for a lot of yield
Walgreens
oriented folks.
hammered. I don't know what it is about Walgreens. Nike too. Nike's just getting beaten with a stick.
Yeah. Well, I do think that there's opportunity. Like, so Nike's got a good business, right? There's some competition with On and Adidas and some new competition and Deckers coming in. But it's still a high quality business that once they get through some of these um, innovation issues, that one could have some legs to it. I think that you talked about your barbell, right? And you've
Yep.
got the one side of the barbell that's like the high yielders, it's like bond-like equities today. And then the other side of the barbell for me is like, where are there really high quality companies that are good at paying dividends, but maybe are going through some temporary issue, right? This is what Powell hoped that inflation was, but it wasn't. It's transitory issues that can be remedied relatively quickly. If Nike's issues can be remedied in the next, 6 to 12 months, it's probably a really good investment. We saw NextEra Energy last fall trade off considerably because people were concerned about funding in the green energy space. And it's been one of the best performing utilities over the last decade. It's driven a lot of these utility-based ETFs. We saw it as an opportunity to get in, and we were pretty fortunate by that. I mean, the yield had popped up to something that we hadn't seen in a long time, and they had the cash to continue to pay the yield, and we're still going to grow at a really attractive rate. So we got in. That's a great investment. I think that from a tactical perspective, if you have a shopping list of really high quality companies that have, for lack of a better term, a moat or a barrier to entry, that is preventing others from coming in and pricing you out of the market, then when those things hit these temporary headwinds, it could be a great time to get in and generate outsized returns going forward. I think, over the weekend, who was it? Starboard came into Starbucks, and now Starbucks was up like 7% on Friday, which those are opportunities which people were talking about. Starbucks is, going to really struggle because they can't figure out their customer service issue and whatnot. So
Mhm.
I think there's opportunities in places like that.
Well, with that being said, because we're talking about Starbucks isn't really a small cap. I kind of put it in the small cap because it's not exactly BlackRock. Um, Lower interest rates. They're supposed to be coming in. I think they're pricing in, a quarter basis point in September. They have to drop interest rates to save the commercial, real estate sector. How does that affect? Do you think that's going to cycle through the smaller stocks and give them some liquidity in the market?
It's already started to filter through a little bit. I think what investors should really look at is the shape of the yield curve rather than being uber focused on just rates coming down. So I think if you do the math, if you see the short end come down by 25 to 50 basis points, does that really bail many of these guys out? Like the Fed's going to have to drop pretty aggressively to get to a point where these smaller companies can refinance on a sound footing, in my opinion. And so I think you're going to see the market's interpretation of that in the yield curve. If a lot of these small caps and commercial real estate guys all of a sudden are getting a sound footing in the market, you'll likely see the yield curve steepening, as that will mean that we're getting back into kind of a growthier environment. If we're not at a place yet where you're going to turbocharge those refinancings and get back to like some, reasonable growth, you'll see just a declining flat yield. It's flat as a pancake right now. It'll just keep coming down on a parallel basis. I don't think that that's really all that good. I think that that's a sign that you're going to have to stick with the Mag 7 and the growth names that have worked. There's this idea, it's not even really an idea, it's kind of proven that when growth in the economy is scarce, growth stocks do the best. And when growth in the economy is plentiful, value stocks do the best. And so
Value
what
stocks being
we're,
like Johnson and Johnson.
yeah, so it's companies that are cheaply priced that can benefit from an economic upswing. And so basically, when the rising tide lifts all boats, those boats that are currently at a much lower place will rise further, is how it tends to work. And so as we sit here today, just looking at what the Fed does on policy, like short-term policy rates, is a little bit less relevant than what happens with the yield curve. And I think it would do people a great favor to focus on that yield curve, because that will tell you, that'll give you some direction on where to go with your portfolio.
If say interest rates come down to 5.5%, would you say that's pretty bullish for the stock market?
You're saying short-term rates or long-term rates?
10-year.
If the 10-year comes down to 5.5 and you're sitting there with an overnight rate at like 4.75 to 5, I think that it's probably a little bit better than we are right now. But I don't think it's like, hey, like all caution goes to the wind and just throw your money on like the smallest names that you can find.
Just margin it
So
all.
yeah, I think that, I think if you were to see some of the political stuff is going to wash itself out, right? Like that just kind of, I think too many people are overly focused on political cycle right now because that's what's in the headlines. But once you get some of that washed out, if you get cheaper money driving the expectation for long-term growth, which is where that kind of yield curve can give you an indication of expectations, that should help you, that should help guide you on how aggressive you can be in the market. If there's a steeper yield curve, I think you could be a lot more aggressive. Than if it's a flatter yield curve. I think you still have to be kind of cautious because the fixed income market's telling us that, the future is not too bright. And, the fixed income market tends to be a pretty good predictor of where things are going. It might be less good today because the Fed's so engaged with it, and the Fed and also DC more generally is very engaged in the bond market. If I would just say that if we see a steepening, that would be a good sign that, we've got growth on the horizon and it's a good time to get into value-oriented stocks.
That's excellent. Um, you spoke a little bit about AI. Now, do you guys do the trading do you have someone that's sitting there trading, or is it AI automated that you just set it and forget it?
Yeah, we don't trade that much. We probably our portfolio has a trade like once a month,
Oh
maybe
wow.
once every 3 weeks. And so that's all done. I mean, we just submit it the old-fashioned way. And then the way ETFs work is there's actually an authorized participant that goes in and does a lot of the trading for you. So we just say, hey, this is what we want, and then they have an algorithm that goes in and figures out how to execute it.
Oh, well, that answers that question. Um, do you think there'll be you brought up the temporary politics. You said it's going to kind of be a wash. Everyone seems to be in their own echo chamber, if you will, depending on if you're on X or if you're on Facebook. Everyone wants to believe what they want. Do you think whoever the president is in running up to the election, obviously like October is normally a sell-off for stocks. Do you think we'll have a run up, a rally?
Um, I don't know. Market in general is tough. I think you'll see what we've seen over the last few weeks is kind of the Trump trade, right? You're getting more of the growthy end, the growthy end with the smaller companies, and more of the cyclically or economically sensitive companies doing well, while your, secular or growthier names aren't doing as well. I think that, and the market has kind of like stayed even. It hasn't moved around a lot, aside from the fact that, the S&P is a little bit overweight, some of that more pricey stuff. I think you're probably going to see some like benign reaction at the market level, and you're going to see a lot of rotation underneath, based on who, like whatever the betting markets are saying on who's going to be elected. That being said, it can change really quickly. Like last week, I mean, we recently did a podcast and I just said, listen, like politicians lie, right? In the campaign season, they promise everything. And then they actually can't execute on providing everything because we don't have a dictatorship society,
Yeah,
right?
for
Like
Mr.
it's not
Trump.
just one person that says, you're going to go throw 60% tariffs on China and everything's going to be good, right?
Yeah.
Because there's checks and balances. And so those checks and balances tend to even themselves out throughout the first half of the term,
Mhm.
and not a lot is going to get done, right? Like unless you get, a complete sweep one way or the other, there's a talk of Republican sweep right now that might be swinging back the other way. If you have a complete Republican sweep, more things are likely going to get done. Unfortunately, when a lot of things happen in the government, that tends to lead to a lot of uncertainty, and the market doesn't like uncertainty. So I can't say, like, I think that some of the policies might be positive, like reducing rates or reducing tax rates is like, not many people are going to argue with that from a corporate perspective. But
Yeah.
that being said, you have to figure out where that money is going to flow when the rule changes, right? And so it turns into, I don't know what it's going to do for the overall market. We can probably figure out who the winners and losers are going to be. And based on how probable each outcome is, place some weightings in the portfolio on the winners away from the losers. Um, but I have a hard time figuring out where the broader market's going to go. I think that those tend to be driven by like bigger macro factors rather than, some of these underlying like political issues.
Mhm. With that being said, Trump is promising corporate to lower corporate taxes from 21 to 15%. I think it's like half the country owns a small business at this point. I think that's probably the only way to survive. Obviously, this would like impact a lot of people, uh, good, bad, indifferent.
I think so there's two ways to look at this. From a fundamental perspective, is it good to have lower taxes? I would say yes, it's good. From a market perspective, what happens based on those lower taxes and improving fundamentals? I don't know. Like based on where the price is today, like I'm not sure that that necessarily means like go buy like, small cap stocks or go buy large cap stocks. Again, I think you have to kind of dig in and figure out, what people actually like what's happening underneath the surface. You know, Republicans win, Republican clean sweep, you can expect healthcare to do better, right? There's not as much tension with the healthcare space. There's a lot of talk about energy doing better. And if you look back historically, the energy stocks did horribly under the Trump administration just because the supply and demand dynamic in the energy patch tends to get out of skew when you allow people to drill everywhere. So a little known tidbit is that Biden was actually better for energy stocks than Trump was because he skewed the supply dynamic negatively while demand remained relatively resilient. So I think that that's the way people are leaning if Trump were to win. If, you know, the Democrats were to win, you could probably expect to see continued kind of haymakers thrown at the healthcare space. So it's probably not a great place to be. You could probably expect to see it be relatively benign markets. You're going to see some of these larger technology companies continue to kind of win the market as uh, there are negative forces towards them, but nothing significant enough to actually impact growth or stock prices for them.
And green
So
energy
that,
is which side is in favor of green energy pushing?
yeah, if Democrats take it, the green energy companies will do much better. Um, Republicans tend to be bigger proponents of brown energy.
Yeah.
So I mean, you could look at the market over the last 2 weeks and you can see who the winners are going to be on the Republican side if the Republicans win. And you can also look to see, the opposite of that's who's going to be a winner if the Democrats remain in power. Um, and it's just really hard. My issue is it's really hard to invest based on political leanings because they can change so quickly.
Yeah.
And so I would just caution people because it seems like 90% of society is like in one echo chamber or the other, wanting to believe whatever, their whatever X wormhole is telling them today. I would just caution people in investing too heavily based on political views. Try to keep a balanced political perspective in your portfolio, because if not, it could be painful.
Mhm. That's a long 4 years to recover.
Oh yeah, yeah.
Yeah, I mean, back to what you said, like I did very well on Occidental Petroleum during the Biden administration. So I have to agree with that. Now I would say my green energy stocks did terrible during the Biden administration. I don't know why. I figured more money would go into that, but my Tesla went through the roof. A lot of people don't
Well,
understand that he gets a lot of government money.
so your unprofitable green energy stocks did horribly, right? And that's an interest rate play. But your profitable green energy stocks have actually done quite well.
Yep.
So that's your like NextEra Energies of the world, has done quite well. So yeah, point taken. Like if some of the green energy stocks haven't done as well, mainly because profits are still a ways out. So when you raise the cost of capital, it makes them some of their projects less viable.
Um, Now does ticker symbol DIVZ, is that you mentioned qualified dividends? Is that a qualified? It is
Yeah.
qualified, or long-term capital gains, whatever you want to call it. They do show up. Okay.
Yep. The whole dividend is qualified. None of it is return of capital, which can be preferential from a tax treatment, but it's all qualified as earned income.
I would think qualified would actually be more tax preferential because it's got a lower
So
rate.
so there's this so when it's considered a return of capital, it's not taxed because they're actually just giving you back the money that you gave them,
Gotcha. Okay.
right? But if let's say that you invested $100 in a fund and they earned $3 in dividends, but they paid you $10 back, right? And they said, hey, look, I have a 10% distribution, and your $3 are going to be taxed at a long-term rate. Your $7 that they gave back to you is not going to be taxed because they're just giving your money back to you. But your new value, your new net asset value is actually 93, not 100,
Mhm.
right? Because they just gave you $7 back that you gave to them. So from an investment management, from a fund manager perspective, it doesn't make a lot of sense for me to sit here and just turn around and start giving you money back that you just gave to me to manage. And so that's why we don't focus as much on those return of capital plays.
So that is, I mean, isn't that the definition of like the Ponzi scheme? And then you guys collect the 1%. I don't know what your percent fee is, but like you just collect am I wrong in that assertion?
Yeah, I think that's half true. It's a big
It's
part of the reason
70%
that
true.
it's a big part of the reason that we don't want to be in that business of just handing people's money back to them that they just gave to us. But yeah, that's fair.
Okay. That's fair. What is the management fee?
We charge 65 basis points, and so it's 0.65%. So that's different than kind of what a mutual fund pays. So the difference between mutual funds and ETFs, and this is something that's really important for people to understand, is that mutual funds have a management fee, and then they also charge the expense of the vehicle on top of the management fee. So they get to like some expense ratio, right? So you as an investor are picking up the cost of actually putting the mutual fund together with a board and legal and all that stuff.
Hmm.
In the ETF, we charge one fee. It's on the prospectus. It's 65 basis points, and we pay everything else. So the fee will never be higher than 65 basis points because we're picking up the cost of actually managing the ETF. So it's kind of an apples and oranges comparison, but a lot of people like to compare the management fee on ETFs to the management fee of mutual funds, or it should really be expense ratio of mutual fund to management fee of ETF.
Yeah, so I know that just for the at-home listener, I know that if I have to go place a trade, say on Schwab, for a Vanguard mutual fund versus a Vanguard ETF, the Vanguard mutual fund charges me $40 per buy order and $40 per sell order. Even though that the price, the NAV price is lower for the mutual fund, you still have to pay this extra money out of pocket that you wouldn't have necessarily had to pay if you just went with the ETF. So I think that's important. And the trading is different, whereas you close at the end of the day versus instantaneously with the ETF. Is that right?
Yeah, I mean, I think mutual funds are horrible for individual investors. I often refer to myself as a recovering mutual fund manager, because I used to manage mutual funds at PIMCO. If mutual funds were created today, the SEC would consider them illegal because they really make no sense. The ETF is just a way more efficient, user-friendly structure. I think the only reason that mutual funds are still in existence is because they're a huge piece of the retirement business, and you have a lot of legacy investment managers who are still making a lot of money on them, and they don't want to give up that revenue stream.
That bread and butter, of course. Is there any future for Opal Capital in the 2x leveraged single fund? That seems to be hot right now.
I'm not big into hot funds. I want funds that are going to be around for, invest that are going to endure for investors. Really, most people need to be investing for the long term. And so I don't want to be creating kind of trendy products that are going to be, exciting and trick people into buying them. And then all of a sudden they wake up one day and they have like half their net asset value in there because, whatever, some derivative blew up. And so our next fund is going to be an international dividend fund that really leverages on my background and my co-PM's background in global dividend paying equities. It's less sexy than, a yield max fund or something that's paying like 20%. But I like to sleep well at night, and I like for my clients to be able to sleep well at night. So we're going to stick with the less sexy alternative of just buying high quality blue chip companies that pay nice yields and buying them at cheap prices.
I love it. Do you guys do you use, kind of getting off topic? Do you use any sort of margin or debt to make these, like future payments at all? No.
No, I mean, we just try to make it kind of plain vanilla, straight down the fairway. It's a little less sexy, but maybe at some point you do like a 20% levered fund if interest rates go back down to a point where it makes sense. But especially right now with where interest rates are, and you can't really cover that yield with a dividend as you could before. So it's kind of less interesting.
This is like a generational wealth fund. I mean, you guys have
We
you guys have a long time horizon. I like this. This is good stuff, man.
we call it the stay rich fund. This isn't the get rich fund. This is the stay rich
I
fund.
like
So
it.
we have an outsourced CIO business where we deal with a lot of individual clients. And inevitably, you'll find clients that have, they've owned Amazon and they have it's like 80% of their portfolio. And they're like, I just love Amazon. I can't get enough of it. And you're like, well, you got rich on Amazon. Let's stay rich by diversifying into this other fund that has more stability, and is maybe a bit more reasonably priced. That's not to say that Amazon's a bad investment, but there was a time when Enron was an amazing investment for all those employees, right? And they couldn't think of anything that could go wrong, and eventually they all got zeroed. And I'm not saying that Amazon's going to do that, but
Yep.
a lot of idiosyncratic risk involved in owning one name. And so diversifying into something that's kind of, when I got a lot of clients that see it the same way.
Who is the target audience of Opal? Uh,
Yeah, I think everyone, because I'm relatively young to be running a dividend fund, but I'm told that our target market is the baby boomers. It's people who have they've already gotten rich. They're looking to stay rich. They're looking to live a nice retirement. They like the yield. They like the fact that the dividend's growing at 5 or 6% a year. It pays out monthly. Those are attractive characteristics. And when the market's down 20, 30%, they don't want to be looking at their statement, seeing, all their funds being down 20, 30%. So one of the things that our style of management has been able to do is mitigate some of that downside when the market goes down. We have a beta on the S&P of somewhere between like 0.6 and 0.7. It really helps in downside, and then we try to catch up with as much upside in up markets as we can.
And you mentioned boomers. Now there's $80 trillion coming from the boomers, asset exchange in the next 10, 15 years. How does Opal plan to capture that?
Yeah, there's kind of two ways. One is just through the dividend ETFs that we're launching. We also run SMAs. Another way that we've recently launched that's been really successful is this outsourced CIO business where we partner up with financial advisors to manage portfolios on their behalf. So they get, institutional grade investment management. They get broadly diversified portfolios, and they're able to offer those to their clients while they can go out and look for more clients and grow their business. So we've actually seen a lot of growth in this business as advisors are focusing more on servicing clients than they are on investing client portfolios. And we think that ends up being a better solution for both the advisor and for the client. We think it's better for the advisor because they can grow a bigger business as they focus on, their unique skill set. And we think it's best for clients because they get the benefit of having an entire investment team poring over their portfolio on a daily basis, rather than it being one advisor who spends half of their time, marketing to clients and whatnot. So it just allows us to provide, I believe, a higher level of service for those clients, and we're able to do it in a pretty efficient manner.
That's awesome. And can the ticker symbol DIVZ, your dividend income, you can get that on all major platforms, I assume, Robinhood, Schwab, Fidelity. Okay.
That's right. Any of the major open platforms, like if you were to go to Merrill or one of the wirehouses, you can get it. You just have to request it. They're not going to market it to you, so to speak, because we don't pay them money. But that tends to be how the business works.
Okay. And where can people find you if they want more information?
Yeah, so there's two places. If you want more information on Opal, you can go to opalinvest.com. And from there you can see all the information on Opal, the different services that we offer, and you can also be linked to our website, which the website for the ETF is actually trueshares.com/DIVZ. So TrueShares is the platform that we use to run DIVZ. It's the Opal Dividend Income ETF.
That's awesome. And I'm assuming you guys are on X, or how do you guys talk to people?
Yeah, so we have a YouTube channel. It's if you just go to YouTube and type in Opal Invest, you can see we do podcasts, about weekly podcasts on there, going through market updates and what we're seeing in the market. It's myself, it's our chief investment strategist, Jake Holter, and then my co-PM, Adam Mueller, who I've worked with at PIMCO and Goldman Sachs for almost the last 20 years. It's the three of us talking about what we're seeing in the market, and we do that about weekly. Occasionally we miss a week here and there.
And do you guys post to X at all?
We post some stuff from our YouTube, but I'm not a big consumer of social media, to be honest with you. I tend to focus on a more durable information that's been around for longer. I've gotten more into it as we've been marketing these products.
Yep.
But I'm a bit of a Luddite when it comes to social media because I haven't focused on it. Facebook actually came out when I was in college. I got one of the early logins based on my, my school email address, which is what you used to have. And I just never used it. I've never focused on it. But we do a bit more of it now that we have a marketing team. But I don't focus on it that much.
Yeah, I know X. There's Facebook, not so much because I have a massive. I don't know. I do like 3 million views a month on Facebook, but on X there is a massive finance, echo chamber, if you will, of people creating ideas. It's not necessarily politically based. It's everyone going, "What's the new stock? Who's doing what? Is there any trades to be had?" And it's a pretty
It
good community of people.
it used to be FinTwit. What do they call it now that it's X?
Like FinX.
FinX? That's the terminology? Okay. Yeah, so we focus on a little bit. We've done some live broadcasts on it. Usually it's on other people's platforms. We have a handle called Opal Invest. Um, I just me personally, I don't post as much on it because it's a bit, as a regulated investment advisor, a registered investment advisor, I have to get my compliance officer to sign off on it before I put it out there. Which it tends to become a little less relevant once I do that. I think there are people that put information out there and say, "Hey, this is not a recommendation," and it's like personal and all that stuff. I feel like it's a gray area in the law right now, so I wouldn't necessarily want to be caught up in that if that changed.
You know what? I will tell you, it takes up a lot of time just responding back to people. I, I could be so much more time efficient if I wasn't on X, but I like I think you would like it because you actually find like-minded individuals. Even if you had a fake profile, you would like, oh, lightning just struck behind you guys. It must be pouring in Boca. Um, but I don't know. I think it's pretty good, but I understand from a regulation perspective, like you really can't. Because people can misconstrue what you say and then make a false accusation against you.
Yeah, I mean, it's just trying to manage that outward message as much as possible without necessarily having the uh like putting yourself at liability from a compliance perspective. And I think you're right. I have been on with, more anonymous handles, but it's not the same as kind of being out there and being like, "Hey, we're on the market buying Broadcom today." Like these are like the 5 reasons that we like it. So if we did post on X, it would be much more of the kind of benign market thoughts, similar to what you see in our, maybe benign the wrong term, but it would be much more high level market thoughts, similar to what you see it with our Opal Investment Insights, which is a podcast that we do on a weekly basis. And we do post a lot of short videos. So if you want to follow, usually Adam has some great like one-liners that are both funny and informative. And so it's just a great place to find those, and those are posted.
Last question, and then I'll let you go because I know you're busy. NVIDIA, is Opal a buyer?
We're neutral.
Neutral.
So
Okay.
they have a really small dividend. It's a great business. At some point, someone's going to come out with a competitive product. I don't know when that's going to be. I think it's safe to own it until people start to say, "Hey, AMD or whoever ARM is going to come out with something." But for the time being, it's a great place to be. They increased their dividend. It was big news was they increased their dividend at last earnings announcement by 150%. And that's just because they did that the split 10-1, and they had to add 6 cents to their dividends so they could pay out a penny a quarter per share. Right. So it's not like they said, "Hey, we want to increase our dividend by 150%." They said, "Oh, now we have to increase our dividend by 150% because we can't pay out less than a penny per share." And so I don't view that as being, necessarily a management team that is committed to the dividend. I think it's kind of like a byproduct.
Yeah.
So we're not overly focused on it, but I know why people own it. And I think that there are some tremendous like secular tailwinds there for the time being.
Personally, I think it's overvalued. And I think once, like you said, once, because those chips are 50, I think it's 50,000 or $5 million, whatever it is to make one chip. Once those come down, you're right. It's going to be the AMDs. It's going to be these smaller companies that are going to be able to actually compete in the marketplace. And personally, I just
Well,
think Nvidia
Dan,
is overvalued.
what why wouldn't you just own Taiwan Semiconductor, right? They actually make all the chips that Nvidia is selling, and they have capacity restraints that are actually causing Nvidia to have capacity constraints, right? And so they're taking the original dig on them in AI was they're not making as much per chip. And they basically, my understanding is they're going back to NVIDIA and they're saying, yeah, you know how you negotiate those really thin margins for us? Well, if you want more capacity, that margin's going to have to go up, right? And so it's a way of playing because I don't think anyone else is going to create their own fab, which by the way takes a long time and a
Mhm.
lot of know-how that very few people actually have. So anyone that actually comes out with this new competing chip is likely going to be producing it out of Taiwan Semi's fab, right? And
Gotcha.
so if you think about like the value chain and where you can capture some of that benefit, just go own Taiwan Semi and you can get it at a much cheaper price because everyone's worried that China is going to attack Taiwan, right? Like if China attacks Taiwan, we got bigger issues than Taiwan Semi, but that just goes to show that you shouldn't put all of your assets into Taiwan Semi. Make it a reasonable position.
If that were to happen, what do you think would be the outcome of Taiwan Semiconductors?
Listen, if China decides that they're going to cut off the Western world from their supply chain, and from their, whatever retail offering, I think Taiwan Semiconductor is going to be the least of our worries,
Okay.
right? We're going to have to go reorient where we get like a third to a half of the consumer goods in the US, right? So you want to talk about inflation, like you ain't seen nothing yet if if China goes and invades Taiwan, right? So I wouldn't worry about like a 3% position in Taiwan Semi. It's just like
The new
in
point, it
investing,
doesn't
you have to
matter.
figure out what to worry about, what not to worry about. That really seems like something that people are like dreaming up and worrying about when it's a moot point.
Yeah.
Like you can't even handicap it, right? So I think it's a great opportunity to get one of the highest quality companies in the world that has a tremendous secular tailwind behind it at a reasonable price, because everyone's worried about those issues.
Austin, I appreciate your time. Do you have any last thoughts you want to share with the audience?
I think I'm good. If you want more information, you can find us at opalinvest.com. The ETF is the Opal Dividend Income ETF, ticker DIVZ.
Thank you so much for taking time out of your busy schedule, and we'll talk to you next time. But let's catch up in maybe a year
Sounds
from
good.
now and see if we can see if things have changed.
Sounds good. Thanks, Dan.
Thank you. Take care.